S&P 500 hitting another all-time closing high for a second day in a row now. We're above that level. Joining me here at Post 9 for how to position at these levels is Morgan Stanley Private Wealth Management's Sherry Paul. Welcome back.
Thank you.
So you look at this market and you think, what? Are you amazed by where we are? You tell me.
Well, I think the resilience of the market now speaks for itself. I mean, if you really, listen to all of the different possible outcomes around tariffs, and we haven't seen a tax bill yet, and corporate profits are sort of reimagining new supply chains, that to see the market this resilient, I think tells us everything about where we can head, which is, going to be higher.
You still think that the trend is up?
I think the trend is up. The likelihood that we get a three-peat, though, of a double-digit return just statistically is unlikely. But from a common sense standpoint, and I think it's important with so much noise, there's so many data points we could look at just from a common sense standpoint. The rotation that we're seeing is really being driven by the tariff policy, deglobalization, some of the trends that we're seeing around longevity. And that means we see a broadening out of the S&P versus last year where we had such a concentration. So that's where I'm positive on the market.
So you're a believer in that continuing, the broadening out of the market?
I am. I'm a believer in sector rotation right now and active rebalancing and common sense investing, which I think there's sort of sense in that basic way that we can all just look a little bit at the world and what we're contending with and start to look where money's going to find that new home.
Okay.
Right now it's in defense spending in addition to continuing to own tech.
I like the idea of cutting through the noise. I think our viewers are attracted to that idea. Cut through it and tell me where I'm going to make the most money.
Yeah.
What do you like in that regard?
Well, I love the U.S. equity markets, transparent capital markets, and the strongest democracy in the world. I'm always a fan of, especially in moments of change like the one that we're in. And I believe that there's a portfolio for every investor that's better and beyond cash at this point. And so if you're unpacking the S&P, you can build your own beta, right, against your own risk tolerance and profile, against an expected alpha, how much return you should get for the risk that you're taking, and really step into areas even like consumer staples. You want to look for a good dividend, a lower beta to the market, get a decent return. That's amazing. Within tech, you're going to take on a lot more beta, but the opportunity for innovation continues to sit within tech. So you're going to pay a premium and know you'll be more volatile. You're going to position yourself for that J-curve return.
Well, you'd be what, overweight tech, or how would you play that as it grew?
I would overweight cloud within tech and continue to equal weight semiconductor and rotate and take gains. If you've been in the semiconductor trade the way that my portfolios have for the last 2 years, then you should be taking gains and rotating into the installation phase and the adoption phase of this AI industrial revolution, which is now going to be as present as the air that we breathe.
Interesting.